So before we officially start, Henry and everybody, if we could put our thumbs up for recording, that would be great. Thank you very much. As we say in this, it's an informal presentation, and very, very kind that Alex has joined us from Ruffer, ably assisted by Toby. If you have any questions on the way, raise a hand. I know there are literally 80 slides, ladies and gentlemen. So hopefully we'll be finished by about 2 o'clock, and we can all go have some lunch. But no, listen, honestly, Alex, fantastic for your efforts. I'll pass over to you, and away you go, as I say.
Steve, thank you very much. I look forward to seeing everyone pinging off the call immediately. But the good news is this is an extraordinarily quick whistle-stop tour. And the briefing was what's going on in the world of geopolitics that matters for markets. And look, the truth is after 10 seconds, my voice has given up. That's a dramatic geopolitical development. The truth is that after a generation where you haven't had to care about really even domestic politics, let alone the shape of world order, now you do. Now, in the scheme of Michel Foucault, who coined the term grey rhino, something very obvious sitting in plain sight that no one refers to or seemingly cares about, but it's incredibly important. World order is one of the great grey rhinos of our time, as opposed, of course, to a Talebian black swan. So without further ado, for those of you that don't know Ruffer, very briefly, we do one thing: we protect and grow money in all market conditions. For all circa £26 billion we look after, that includes a lot of pension money, of course. We've been doing that same thing since the early 1990s. And in green, here's Ruffer's performance, annualizing just under 9% net of fees. Excuse me, dramatic. And along the way, preserving capital through all four major crises of the last quarter century, and actually growing it as well. Anyway, enough of the boring puff piece. I want to talk about UFOs. Now, I did actually hear on a podcast a respected financial journalist not so long ago. He had a guest on who was a self-styled UFO expert, in inverted commas, and he suggested he was long various US defense majors because he believed they had extraterrestrial propulsion technology. Now, I'm glad to say I'm not going to be making stock recommendations based on Roswell incident, but I am going to talk to you about an unfriendly outlook. And of course, the thing that has really crystallized this unfriendly outlook in many people's minds was Balloongate this year. After a brief warming period between the US and China, Balloongate sent the balloon up. And then suddenly Americans were seeing UFOs everywhere, and they were scrambling their Raptors to shoot down at colossal expense things that invariably turned out not to be Martian exploratory vehicles, but instead balloon club things worth a couple of $100 shot down with missiles worth hundreds of thousands. But before we go on to the exciting stuff that lies ahead, I want to do a couple of lessons from last year. Last year was really the year that exploded magical thinking left, right, and centre. The war in Europe, the largest war since 1945, putting paid to the idea of the end of history. Nuclear saber rattling, living once again under the shadow of the mushroom cloud. The end of free money, which for investors is the salient and central fact of our time. Energy security, the assumption that energy would be reliable and free in the modern era. You can't take that for granted because of all sorts of extremely unwise decisions. The supremacy of tech, which got it in the neck last year, not least because of the return of inflation to 40-year highs, which everyone also thought was dead. And of course, with it, central banks' reputation for controlling inflation turned out to be as chimerical as everything else. Now, here is inflation in the US and the UK going back to just after the Wall Street crash. All you got to care about really are two things. Number one, the last 3 decades have been extraordinarily atypical, historically speaking. You've had stable and low inflation driven by all sorts of things, most of them linked in some way to world order, the return of China to the global trading system, the end of the Cold War, the effect of technology, the small state revolution of Thatcher and Reagan, you name it. An incredible confluence has given the most extraordinary golden era for capital, and that shapes the professional careers of almost everyone operating in markets today. Two things that kicked us out of that regime. One, the political response to COVID. It wasn't COVID itself. It was politicians' choices about how we responded. And two, that largest war since 1945 in Europe. That exploded a few assumptions in the investment world. Every year since the end of the Cold War, one line here is plotted for a global bond market aggregate. And basically, the dark line is last year's performance. In other words, bonds turned out not only to be not very helpful, they were often worse than equities, since most people work on the assumption that bonds, your primary offset, it was a rude awakening. And the truth is, depending on which bonds you're interested in, you actually have to go back 70 to 100 years to see bond performance that badly. But it was worse than that. It wasn't just you lost money in equities or bonds, it's that actually at headline levels, you lost money in almost everything. If I'd given you a crystal ball and I'd allowed you to pick the best performing global asset class out of EM, equities, credit, bonds, same for developed markets, and all sorts of other things, going back to 1980, when that small state revolution began, you'd always have been able to find something that went up. And that's what the green bar is showing you. That's the best performing global asset class over the last 40 years. Last year, 3 quarters in a row, everything went down. So that's why you need to be focused on reappraising your assumptions about portfolio construction. Here are some of the things on a tactical basis we're thinking about at the moment. The first is that the extraordinary 5,000-year lows in interest rates have gone into reverse, and with it, the monetary experiment that central banks have perpetrated on us. And that means we're worried that the tide that lifted all asset boats, particularly over the last 15 years, is going into reverse, and that means more liquidation pressure later this year as the amount of money in the system available to support asset prices recedes. And here is a chart of central bank balance sheets, the major central banks, versus global equities. It's not a coincidence the shapes look extremely similar. Key point is, for the first time in half a generation, cash gives you an alternative. For a long time, you heard investors mutter darkly that there was no alternative. You just had to pile into risk to get any sort of return. Well, this is US 1-year bonds in green and 10-year bonds in blue. And for the first time in a very long time, you actually get quite a respectable return in nominal terms. What you do know for certainty is that when the Fed starts hiking, something always breaks. This is the US 10-year yield going back 50 years. And over that extraordinary period of falling rates, falling inflation, and falling volatility from the middle of the 1980s, bounded by those upper and lower perforated red lines, you basically had this golden era for capital. But every time the Fed tried to raise rates, something broke. The Mexico crisis, Asian financial crisis, dot-com, savings and loan, you name it, it kept going down. We've smashed through the top edge of that long-term decline line. And remember what's been going on in the background. We've been taking on more and more debt, and the system's been getting more and more fragile. Credit Suisse, the UK bond market, Silicon Valley Bank, these are not the last bodies to float to the surface. There's going to be a lot more. It takes a long time for rates to work their way through the system. Bottom line is that we think there's a hard landing coming. Hard landing, of course, meaning recession. We expect a recession this year in the United States. It's not a guarantee, but the market is not priced for it. On the bull side, one of the major political developments of the last few months, of course, is China's much faster than expected reopening. Here's the financial district in Pudong, which is in Shanghai, over the Huangpu River. And there's potential upside, particularly in the commodity space and China-focused equity. So we've got a bit of that at the moment. Tactically bullish doesn't mean long-term bullish. China's housing market, demography, more and more political control in the economy. These are hugely important structural and chronic headwinds for the Chinese economy that you need to be very live to. Now, shorter term stings in the tail include much neglected doorstep conflicts in Ukraine. Here's the latest Russian occupied territory in red. Bottom line, Russia's failed to break through in substantial scale so far with its spring offensive. The Ukrainians are gearing up for their own counteroffensive, probably starting this month or next month. Base case is probably that there aren't any dramatic changes in the front lines. But when these sorts of offences are going on, you have to be cognizant that sudden changes could lead to dramatic escalation. And there's basically nothing in the price of what's going on in Ukraine at the moment. And beyond that, of course, the truth is that Taiwan, the mantra being Eastern Europe today is East Asia tomorrow, Taiwan disruption would make what's happened with respect to supply chains around Ukraine look like an amuse-bouche. This chart shows you the areas that the Chinese effectively blockaded with live fire exercises when Nancy Pelosi visited last year. Again, you've got to remember the political dimension now that's driving so much. Taiwan's responsible, as we all know, for 90% of the most advanced semiconductor production and about 35% of total global processing production. So imagine if that got taken out by blockade. Iran, nobody really talks about at the moment, but you would have seen the IAEA headlines about finding traces of highly enriched uranium, about 84, 85%. You need 90% for a weapon. And of course, once you get to that level, the material can be moved from the centrifuges to areas for weapon assembly. And that's very dangerous because it means that the window for the Israelis or the Americans to do something about it gets very tight. Given the domestic political crisis in Israel, timetable around the US election, the extreme pressure the regime in Iran has been under, and the fact that all sides regard possessions of nuclear weapons as an existential threat, for different reasons, this is a neglected area of risk, particularly in the commodity space. So those are the tactical issues. And of course, on the oil front, we also had a reminder that OPEC Plus remains a formidable, albeit somewhat diminished cartel, given their recent decision. But let's take a step back and look at the strategic picture, because the truth is, in this sort of environment, we need to approach it with maximum humility. There's an awful lot of noise. It's hard to discern short-term signal, particularly as the world continues to digest the extraordinary dislocations from COVID. And I don't think you can underestimate what a big hit that has been. Plus, of course, Ukraine turbocharging some of those trends. But let's take a really long view. This chart is showing you, going back 2,000 years, the relative share of global output of all the major economies. Now, the first 1,500 years are rather cheekily crammed into the 2 inches on the left-hand side of the chart. The bulge in the middle is Western dominance off the back of the Industrial Revolution. And the entire environment, the totality of world order we are used to, is coloured by 2 and a bit centuries of Western dominance built off mastery of dense energy and a technological lead over everyone else. What you can see now is that world order is normalizing, and that China and India are reverting to much more like their normal historical role in the system. And if you asked our ancestors from the year 1700 what the big actors in the world were, they'd say Peter the Great's Russia, Manchu China, Safavid Persia, that's Iran, of course, Mughal India, the Ottoman Empire focused on Turkey and the Eastern Mediterranean, European states, Spice, Night, Ferrets, and Sack. That's what the map here is showing you from 300 years ago. That's pretty much the same list of actors today. So we're going back to a world order much more familiar to our ancestors, much more divided, much less stable. And of course, you can see here with trade restrictions imposed by volume across investment goods and services, there's been a step change from the laissez-faire period that we were used to for several decades. In just the last few years, dramatic increase in trade restrictions. And here are the estimates of what that's going to cost in terms of global growth. Quite a wide delta on that, but these are significant moves. Now, at the center of this more disorderly multipolar era is a new Cold War with China and America, which we first identified in 2017 and 2018. Do not underestimate how significant this is. Here is Mr. Putin and Mr. Xi meeting on the eve of the Ukraine war when they declared their infamous no limits friendship. Money follows political decisions. This is China imports from Russia, going back to the early 1990s, end of the Cold War. And you can see the war in Ukraine hypercharging their trade interconnectivity. Effectively, the Ukraine war has made Russia absolutely the junior partner to China, and that's what Mr. Xi's recent visit to the Kremlin was all about. Here he is saying farewell to Putin on the steps of the Kremlin, and that rather disturbing exchange. Mr. Xi, right now there are changes the likes of which we haven't seen for 100 years, and we are the ones driving these changes together. They really believe this. There is a concerted attempt for the first time in a generation to seriously challenge US-led world order. It's not a values statement. It just means there's choppy water ahead. Now, unsurprisingly, in the aftermath of the invasion, the weaponization of the dollar, the world's great reserve currency in the euro, number 2, gold has regained a bit of its luster. Again, always trying to plug the geopolitics back into what's actually happening in markets. Here are the net changes in central bank gold reserves going back a couple of years. And you can see very clearly after the invasion, the weaponization of those currency reserves, that central bank purchases of gold step up, and China and Turkey, unsurprisingly, which might find themselves on the wrong side of the United States, the biggest buyers. On that push for an alternative world order, here's China's chief diplomat Wang Yi meeting with the Iranian and Saudi delegation to foster a rapprochement recently. America's withdrawn to some significant extent from the Middle East, and China's stepping into the void. And they really are pushing hard on the narrative that America is the destabilizing power globally. Here's one of the Chinese government spokesmen on the China pitch, which is solidarity and cooperation and economic development, no questions asked, versus the American pitch, which of course we know is autocracy versus democracy. Now, the Americans may have been retreating in some areas like the Middle East, but they've been pushing forward their containment policy elsewhere, corralling the Anglosphere with the AUKUS deal. This is real serious money over a very long period of time, benefiting, for example, prime UK contractors like BAE Systems on the submarine front. And the Japanese, very significantly, have made it clear which side their bread is now buttered on. Here is Prime Minister Kishida asserting a more muscular Japanese foreign policy, recently visiting Kiev, whilst Mr. Xi pointedly was in Moscow. And the Japanese have just hiked defense spending by 26%. That's en route to doubling it from 1% to 2% of GDP, including purchasing hundreds of these Tomahawk cruise missiles. This is an offensive military capability, and that's a big deal for a pacifist state like Japan. So you should expect arms races, including, sadly, in the nuclear sphere, are going to continue. But from an asset allocator's point of view, it means you need to be much more concerned about these lobster pots. Lobster pots are investments in exotic climes that offer you seemingly generous returns, high yields, easy to get your money in, very difficult to get your money out, as lots of companies discovered to their significant financial cost after the invasion of Ukraine. All of the businesses here, major global companies, had significant operations in Russia. They self-sanctioned after the invasion. In the case of BP, which we owned a decent slug of, that was a 10% haircut because of the Rosneft stake. So you need to apply new filters in this more geopolitically unstable era. And of course, added to the mix is rapid technological change, which is very destabilizing historically in geopolitical terms. Think about the 1906 launch of HMS Dreadnought, the first all-big gun, steam-powered battleship. It made every other warship afloat obsolete overnight. Sputnik in '57 convinced the Americans they were behind in the space race, which at that point they were. ChatGPT, just a retail window onto the extraordinary changes that machine intelligence are going to wreak in every area of our economic and political existence. And who controls the data and the processing power wins. And that is why the tech war is so central to what's going on. It will also enable some frankly terrifying new developments. Ukraine is a sort of hybrid war in the sense that it's both the last big war probably of the 20th century, trench warfare, artillery duels, things that you would recognize from World War I, but also a huge role for drones, crossover consumer and commercial technology being used on the front line, network warfare, and faster kill chains. And technology will allow drones to operate autonomously in huge numbers. This is a swarm of birds I'm showing you on this screen, but we are going to see similar things to this in the drone space, and these will be game-changing developments. Now, beyond the geopolitical disorder, the domestic political reaction function is changing, and that's because of some huge structural shifts in the investment environment we find ourselves in. Here's the Japanese population pyramid, showing you out into the future how that huge bulge of post-war babies is aging, and the fertility ratio has cratered. And the reality is that aging is a feature of almost all major economic blocs. Here's France, China, and US, the percentage of the population over 65 years old. And the story of this century is population bust in a demographic front, unambiguously population bust. Here are the most populous countries in the world with their projections out to the end of 2100. China's population is set to halve by the latest 2100. I suspect the figures in China are significantly worse. And the relevance here is that if your economic growth rate does not keep up with the growth rate of your aging population, then they take more and more as a slice of the pie. There's less and less to invest. And of course, you get a compound slowdown in growth. This chart is showing you France GDP year-on-year growth, and the dotted line is the growth rate as things stand of the over 65s in France. And what you can see is that economic growth is substantially below the level of economic growth. That means public finance crisis is guaranteed. It's not just France. South Korea's pension funds just said it's going to run out of money just after the middle of this decade. On the right-hand side, if you've not heard of witch houses before, you're going to see more of them in many economies across the world. These are basically abandoned properties because aging reduces the structural bid for certain types of assets, and that's pretty material, of course, for us as investors. Problem is that the political economy is not ready for the kind of things required to fix these chronic public finance issues. Left-hand image from the National Assembly in France as Macron used his controversial 49.3 constitutional clause to bypass a vote in Parliament to get his pension reform through, only increasing the age from 62 to 64. The result on the right-hand side, massive protests and strikes. And what about the energy transition? All economic activity is energy transformed. Politicians have been driving an extremely aggressive net zero agenda, frankly, I would say often incredibly naively, because we're trying to ameliorate the effects of the first industrial revolution with a second one, a shift to green technology, lower pollution, but also crucially less dense energy supplies. And that's really significant geopolitically, because the map we've been used to in terms of the energy landscape of the world is this one here. This is the world map shaded by countries according to whether they're net exporters or importers of energy. Darker is obviously net exporters, Middle East, Russia, the really big players here, Venezuela as well, but of course they're heavily sanctioned. In the new era, you need to overlay that map, which is actually going to get more concentrated because of the way that the Western investor base and governments have insisted that their own companies run down oil production, handing more power in the medium term to state producers of oil, and those are overwhelmingly, by the way, the largest producers globally. Western oil majors are a rounding number. What I'm showing you here is the same world map, but shaded according to energy important metals. So these are metal ores, and it brings a new cast of characters: Brazil, Australia, Indonesia, Southern Africa into play. Now, the problem is that the energy transition is going to increase jurisdictional risk. What I'm showing you here is the concentration by the top 3 producing countries of selected minerals and fossil fuels. And you can see that for lithium and rare earths and cobalt and graphite, the concentration risk around those minerals is much higher than for things like natural gas and oil. And on the right-hand side, the processing of those same materials, extremely concentrated, particularly in China. And it's not just metals processing that China's got a strategic chokehold on. It's also the all-important battery supply chain and electric vehicle supply chain. You can see here along the bottom, those are the major economic blocs and their share of the various bits of the battery supply chain. China has strategically targeted this industry with a long-term view on it, and the Western states are only just getting out of bed in this race. Physical changes from a changing climate are also changing the geopolitical landscape at quite a clip. In this case, opening up the northern sea route, which massively cuts the time from Chinese ports to Northern European ports, saves money, but it also means the Arctic, as the ice retreats, becomes a much more intense sphere of geopolitical, military, and resource competition. And you're seeing that playing out at the moment. Perhaps if Mr. Trump, boosted perhaps by the fallout from his impending arrest, perhaps if he's back in, we'll have a reprise of this rather gaudy, hopefully jokey proposal for what he wanted to do when he offered to buy Greenland. But the reality is a changing climate is going to put huge pressure on individual companies, entire geographies. I'm showing you here, particularly with respect to water, red areas are places with least spare capacity. They're also, by the way, many of the most populated areas in the world, China and India amongst them. They're going to put huge pressure on things like migration flows, which has an immediate feedback, not only economically, but obviously politically as well. And also water wars. You should expect conflict around water, around the Himalayas, around the Grand Ethiopian Renaissance Dam, potentially coming off the Ethiopian highlands. And that means we need a lot of money to boost our infrastructure. Here are a few examples. Top left-hand side, last summer when we were basking in plus 40-degree heat across Europe, turned out that British railway tracks are optimized really for life at 27 degrees. Luton Airport's runway melted. PG&E, a Californian utility provider, filed for bankruptcy because its pylons sparked wildfires. New York is having to build a huge seawall to defend itself from rising sea levels. There's going to be a massive continuing infrastructure push. But basically, that means you need a lot more of those minerals we were talking about with the world map a second ago. On the left-hand side, minerals required in a conventional engine car versus an electric car, vastly greater in the latter. On the right-hand side, natural gas resources required to extract certain amounts of energy, much higher for wind farms and solar versus the energy-dense success stories of the last 200 years. And that means we think there's going to be a mining capex boom. This is probably the last year, 2023, where the last big wave of permitted developments in spaces like the copper market actually come on stream. It takes 10 years, highly political to get these projects going, particularly when if you look at Latin America, governments are increasingly exercised not only about the economic fallout, but also about exploitation of resources by large foreign companies. Legacy energy is also going to be a big area of opportunity and cash flow, as Matt from the Telegraph reminds us here. But of course, the North Sea point reminds us also about the risk of political intervention. We've had a sort of Augustinian moment from the Biden White House a few years ago. Lord, make me carbon chase, but not yet, as they simultaneously restricted drilling permits domestically in the United States, but then railed against OPEC for not pumping more oil elsewhere. Bottom line is, thanks to extremely naive net zero plans in many cases, baseload power is back on the agenda, and the only thing that can provide the sort of dense, stable baseload power, in my own view, is nuclear. I think that's going to have to be a much larger part of the mix. We own a bit of uranium as a result. In the last couple of years, particularly catalyzed by the Ukraine war, geopolitics re-injecting some realism into the energy debate. Suddenly you've had from Japan to France to the United States, to Sweden and all sorts of other countries, a reversal in their nuclear plans, not only reactivating mothball plants, but also contemplating the rollout of new ones, including things that you'll recognize by the name of small modular reactors, our own Rolls-Royce in this country pioneering that. The truth is you've got to pay for this somehow. All of these huge shifts from greater defense spending to net zero to aging to healthcare and everything in between require money. And the problem is we're incredibly indebted. This shows you debt to GDP going back to 1880, the advanced economies in green and the emerging markets on average in blue. Last 40 years, as remember, rates, inflation and volatility were falling, has encouraged people, of course, to take on more leverage. That's taken us up to record wartime highs, and we haven't even been fighting an actual large-scale war at the moment, but now we're talking about paying wartime economic-style bills with respect to net zero and all the aforementioned structural shifts. That means to us that it's almost inevitable the authorities will choose financial repression, and that's a world where inflation and nominal economic growth are kept ahead of the rate of interest to stealthily default on the nominal debts that have been accumulated. And that brings us to the domestic political economy. We've lived in market terms in an era where people have worshipped central banks. Don't fight the Fed, the Fed's got your back, buy the dip. The supremacy of central banks is basically a function of an era where structural tailwinds from things like the end of the Cold War and China's accession to the global trading system put massive downward pressure on prices. And it gave central banks the space to appear that they were in control, that they'd mastered inflation, they'd found the secret sauce. Now you need to focus much more on what the politicians and legislators are doing, because the truth is, when people have to pay a lot more for their energy and food, they don't like it. And incumbent politicians get kicked out of office. French Revolution, top left, Sri Lanka, top right, Arab Spring, bottom left, Gilets jaunes in France, all examples of the massive political backlash. So all of these factors together mean that Leviathan, the big state, the interventionist government model, is firmly back after the abeyance post-Thatcher and Reagan. It's firmly back. And if you want the clearest example, look at the legislation going through in the United States. The Inflation Reduction Act, the most ludicrously titled piece of legislation, arguably of all time, since almost everything in it will exacerbate inflation pressures, at least in the medium term. The idea here is to break China's chokehold on the battery and electric vehicle supply chain, and also on other areas of clean tech like solar. The 369 billion price tag sounds like a lot. It's tip of the iceberg. This is designed to catalyze 10 times plus that amount in private money. And we're seeing something similar with the CHIPS Act, which focuses on semiconductors, strategic resilience, and of course the Infrastructure Act as well. And it's the way these things work together. And here you're seeing in the various blocks over the last 30 years, average annual spending in the United States on these big structural economy reshaping bills. It's a step change, in short, and Leviathan is very much back. And the truth is that when the authorities have to choose between financial stability and letting their political projects go to the wall, they're going to allow more inflation. Here's the Eurozone debt to GDP on the right-hand side, a map you'll be familiar with. Greece, Italy, Southern Europe, much more heavily indebted than the Northern Bloc. On the left-hand side, this is inflation. Darker shaded countries have higher inflation. The Baltics have had over 20% inflation in recent months. No one expects the European Central Bank to allow the Eurozone to go to the wall by keeping policy too tight for too long, though of course they will do that, but they'll almost certainly retreat in the first instance, rather than really threaten the position of Italy or Greece or the rest of the peripherals in the Eurozone. So more inflation is the choice that we expect the authorities to make versus financial stability. And you've seen that arguably in the response of central banks to the banking woes recently. Here's Schnabel of the ECB accepting that the energy transition is going to put upward pressure on prices anyway. Remember, these are political choices that are being made. And so the central risk as we see it is that these structural pressures toward a more inflation-prone and volatile system coming into view are meeting an inflation-intolerant financial system optimized for life in the low and stable world of low and stable inflation, low and stable interest rates, low and stable volatility that's dominated for a whole generation. And you're starting to see through SVB, through Credit Suisse, through crypto, through the gilt crisis last year, what happens when those two things meet. And it's not pretty for investors if you're not prepared. Good news is these structural changes mean huge opportunities. It's not a manifesto of gloom. It's actually much more like the environment our recent ancestors were used to. You just need to think about different opportunities. One of them is commodities. This line plots US equity versus Goldman Sachs commodity index back over 50 years. When the line is low, commodities are cheap versus history compared to equity. And we see a lot of opportunity there. These are the biggest companies in the world by market cap, ex-Saudi Aramco, in 1980, 90, 2000, 2010, and 2021. And the point here really is just that the companies that have dominated each era have been very different. It was oil in 1980, it was Japan in 1990, it was tech in 2000, it was China related in 2010, and it was tech of a slightly different flavor, again, most recently. Technology remains central, but don't expect the winners of the recent past to be exactly the same over the next decade. Instead, there's a huge and exciting smorgasbord of structural opportunities, whether it's nuclear, whether it's power semiconductors for the electrification of everything, whether it's battery supply chains, whether it's defense, whether it's drones, natural gas, you name it, the opportunities abound. But the central thrust you should be focused on is that inflation risk is growing. Even when inflation from the current wave rolls over, those structural pressures around more interventionist governments, more politicized central banks, aging, breakdown of world order and reglobalization, more natural risk, all of those things are pushing up the structural systemic propensity to higher inflation. Not that you'd know it from market pricing. Here are US break-evens, measure of inflation over 2, 5, 10, 20 and 30-year periods. Ignore the noise around the 2-year, which is obviously taking into account recent developments. Long-term inflation pricing remains flat as a pancake, and that to us is why things like long-dated inflation-protected bonds in the US and the UK look very interesting. So, to conclude, in a more volatile era that's distinctly unlike the extraordinary atypical period of historic calm we've enjoyed post-Cold War, you need to think differently. Don't rely on the things optimized for life in that stable, geopolitically peaceful era. You need to be much more active. You need to use cash because that's going to help you avoid being on the wrong side of liquidity pressure and allow you to take opportunities as we go into this more shock-prone world. That'll help you be anti-fragile. To us, we also use derivatives because we're worried that actually if there is a bit more inflation pressure, the correlations of equities, bonds and all other conventional assets will be more positive. And that means finding true hiding places will be harder. You need to use derivatives. Both of those things will help you make time your friend because you don't want to be timing lots of these shifts. We don't think anyone can do that. So you want to be set up well in advance. You also want to own real assets that the governments can't print. Governments are not your friend. Leviathan is here to steal your money by stealth. So I hope that's given you a sense of why we think the world is going to be more inflation prone, more volatile, and why it's going to be paying huge dividends to think differently to the last 30 years and look at the opportunities that this kind of disorder brings, not least from growing geopolitical instability. So, Steve, I think that was nearly 30 minutes. Best part of 80 slides. I did promise you a whistle-stop tour. So I'll stop my monologue and thanks so much for your time. Love to take any questions.
Well, that was a whistle-stop tour of the global markets and global opportunities and history, obviously, which some of us will remember. Not that many of us will remember some of the older stuff, but the point is, I think that the markets are very volatile, and I think that the crux today is where do you invest? One of the slides you were talking about is, well, everything's going down. If you're holding cash, inflation is going to eat away at that. Where do you invest? If commodities are going down and equities are going down and everything's going down, everything's going down. What's your obviously I like the last slide, which is talking about being positive and talk about real assets, but where are you investing today? Where is Ruffer investing in the next sort of 6 to 12 months? What's hot in the pipeline? Let me put it that way.
Well, remember, Steve, that at Ruffer, even though we've got strong views about the long-term macro picture, the entirety of our portfolio construction is designed to avoid losing money in any conditions and to make money in any conditions. So we always need a balance of assets. There's always got to be something on the growth side as well as the protection side. So at the moment, we've got commodities and equities focused on China's reopening that will also profit if global growth is better than expected and the most forecast recession in history doesn't arrive. You can play that through various things, the direct commodity, the equity, but also currency, the Australian dollar, for example. We've got positions that profit from a rally in duration. So bonds, gold. We've got downside derivative protection focused on credit markets, equities, and positions that profit from high yields in Japan if they actually end yield curve control. So there's a smorgasbord, all carefully calibrated to create some portfolio balance. But look, the reality is, if you can preserve capital in this environment, of higher volatility, the opportunities come to you. And last year, we were up because we used alternative protections. We weren't reliant on conventional only offsets. And that meant that when, for example, the gilt market meltdown happened at the end of last year and duration sold off globally, we were able to snap up at extraordinarily attractive prices, huge amounts of UK and US very long dated debt. It rallied hard. We were able to take profits. So you want to be liquid, you want to preserve your capital, and the opportunities come to you.
Yeah, good answer. Good answer. And again, towards the end of the presentation, there's some exciting slides about energy and about fintech and about battery power and the rise of electric cars. My son's just got himself a new electric car, and the cost of providing that electricity. Where do you buy it from? The infrastructure of where the hell do you go and get these things? Because the map shows you where you're going. But as time goes on, if you're selling 50,000 cars a month and you've only got 5,000 plug-in points, something's got to give. So there's got to be a lot of infrastructure to be built in that space, particularly.
Huge infrastructure build out, and that's one of the reasons we own copper, because it is the missing ingredient. Supply is physically constrained. It's very hard to get permitting. This year, as I say, is the last year that you probably get the old cycle new large projects coming on stream. But beyond that, it does look interesting. But look, the bottom line is, as I say, every era has its own different investment opportunities. There are always opportunities. I mentioned some of them at the top. It might be mining equipment, it might be semiconductors, which you're going to see relentless demand for. We've got various niches in the semiconductor supply chain, particularly in Japan. Japan remains an incredibly interesting and neglected market. In the value space, UK equity, Japan small cap, there's loads of stuff there. So as long as you're prepared to broaden horizons and not be wedded just to what's worked for the last 30, but particularly the last 10 years, it's going to be a really interesting opportunity-rich environment. You just got to preserve your capital through the pressures we think are coming, particularly around liquidation.
Yeah. Okay, cool. Henry, you got your hand up. Do you want to ask your question? And I'm sure Con Keating or Adrian Swales will have questions, and this is right up their street, as I say. So, Henry?
Yeah, hi, Alex. Thanks for that very good presentation. Listening to you, especially the last 2 or 3 minutes, it sounds as if you really have adopted the mentality of a hedge fund manager and look at sort of these issues as opportunities. Are you in the business of going heavily into private markets? Are you buying short on markets as well as going long on them? Are you adopting the kind of macro strategies which your narrative would suggest you ought?
Thank you very much for your question, Henry, and indeed for your time. Short answer is we are a macro-driven fund. So what really matters to Ruffer is getting the strategic asset allocation right, but we're also super liquid, and that's very important. We aren't investing in private markets, and when you go to a lot of alternative managers, in inverted commas, they'll say, well, we'll give you a different return stream, but brackets, that's because we're going to lock up your money for months and you won't be able to get at it when you want it. We are, by design, super liquid. So you could get everything out of our funds next week if you wanted to. And we therefore operate almost exclusively in liquid markets. And case in point, last year would be when some of our pension clients operating in the defined benefit space needed a lot of money very quickly after what happened in the gilt market. We were able to pay out 9 figures or 10 figures in very short order to them.
Yeah, okay, so liquidity is high on your list of pluses. On the way you look at the UK markets and so on, obviously there's not a lot of space in the pension market on the defined benefit side for sort of a long-term growth orientated view. Where do you see the opportunities?
In the UK?
Yeah.
I mean, I think basically right across the spectrum. Actually, the equity that we have in the funds at the moment, which is UK based, is quite misleading because it's things like BP, which are basically global dollar earning companies. We do have a UK mid and smaller cap funds that invest in a very wide range of things. But the UK's got structural discounts. It's got a structural political discount post-Brexit. It's had a structural discount for the last decade, courtesy of the primary constituents of the indices. So no one's wanted to own banks, no one's wanted to own oil or energy, no one's wanted to own commodities. We've got loads of all of them. And because the structural buyer has been bailing out of UK equity, these things just don't trade on expensive margins, or expensive ratings. So
you see investing in the UK as a good idea. Do you see many UK investors who you can sell to?
That's the reason it's cheap, isn't it? Exactly to your point. So in a kind of more inflation-prone, faster nominal growth era, there are lots of companies that should profit, and you can hold them for the cash flow and the dividends. What we don't have is lots of the sort of growthy tech that's dominated the last market cycle, but the UK's got a lot of very interesting opportunities.
Do you think the markets are going to? I mean, the pension market in particular has been very much orientated around, especially the DC side, low risk, passive investment without the cost of going for these kind of long-term returns, and obviously a large amount of money tied up in bonds. Do you see that changing radically over the next 5 to 10 years?
I'm the wrong person to ask about what pension funds may or may not choose to do. My colleague James will probably opine, but I think the message I'd want to get across is that the assumption that bonds are safe was torpedoed for a lot of investors last year, when bonds often did worse than their equities. And it's a bit of a sick joke to tell people who really need their money, i.e. pensioners, that they should be loading up on bonds during the middle of an extreme bubble, which arguably was centered on bond valuations. So in some cases, bonds are now offering more interesting value, but I think what everyone should be focused on is the idea that things that we've been told for a generation are safe assets in a more inflation-prone and higher positive correlation world may prove to be anything but. James.
Okay.
Sure. Just to add, thanks, Alex. I think our views on the sort of structural pricings that we see in DC over the short and medium, and for that matter the long term, are one, you've got the regulator now quite clearly focused on outcomes and not cost, which I think is supportive of underlying quality of investment. And then secondary to that, we have existed, as Alex has talked about in this presentation, in an environment over the course of the last 10 years in particular, whereby via quantitative easing, prices have been massaged upwards. You've therefore been afforded the opportunity to hold ETF index funds and run a portfolio at 10 to 20 basis points, and the performance has been successful because of the byproduct of the market backdrop. We believe that investment regime's now changed. QE no longer exists, it's in reverse. And so the idea that asset prices are going to be massaged up leans you towards this idea that there needs to be some new thinking around portfolio construction, and you won't enjoy the successes from a performance standpoint that you have over the course of the last decade that you might for the next 10 years.
Okay, thank you.
Okay, Con Keating, you've had your hand up for a little while. Do you want to ask a question, Con, or indeed make a statement?
No. I've a couple of questions to ask. I guess one's easy, one's hard. I'll let you decide which is easy and which is hard, Alex. The first question is, I agree with your analysis that we now have structural inflation pressures built in almost everywhere we look. The question really is, how long is it going to be before markets come to realize that? The second question is something that you didn't mention at all in the course of your presentation, which I thought, by the way, was excellent. And that is ESG just a sideshow in all of this?
Thank you very much, Con. It sounds like two hot potatoes to me. The first is that the first answer is don't know. And I've been surprised that there's been nothing at all in the price for higher long-term risk of inflation. And I think what that's telling you is that the market believes the emperors still have their clothes. The central bankers are still in charge, even though, of course, they're not the ones that actually control long-term inflation at all, as evidenced by the fact that you suddenly had various figures like Blanchard at the IMF saying, oh, well, maybe 3% is the new 2%, or maybe 4%. 2% is arbitrary. And of course, 2% is completely arbitrary, but they don't control long-term inflation. So we don't know. That's why we own a structural position in long-dated inflation-protected bonds, because the thing that could change market psychology, although frankly, we expect it will take quite a lot more of the sort of thing we've had recently to convince investors that they should be reappraising that long run trajectory. It could happen very fast. So we've got those positions built in to protect the portfolio anyway. ESG is a hot potato because what people mean by it is often very different. I'd make a couple of quick observations. The first is that ESG is a feature partly of an ultra low rate world where it was very hard to beat the index, and managers had to do something, in inverted commas, to justify active fees very often. That's not to say, incidentally, that some of the things that are covered by the ESG umbrella aren't important. It's just to try and understand why it's become as deeply embedded in the asset management system as it has done. It's also part of a broader politicization of everything that's afflicting societies around the world. And I think last year in particular was a brutal check on a lot of very naive ESG inverted commas thinking. In energy in particular, you've got the ludicrous spectre of the German government, because of the Green Party insisting that their remaining nuclear reactors were shut down, and having to cover the energy shortfall of nuclear, which by the way is completely carbon free, with firing up lignite coal stations. Now, lignite's the dirtiest form of coal they burn. Madness, particularly from an environmental point of view. And incidentally, who was it that funded a lot of the early anti-nuclear campaign in Europe? It was the KGB. Why did the KGB fund a lot of the green campaign in the second half of the 20th century? They wanted two things. They wanted Europe to remain addicted to Soviet gas and energy supplies, which it did right up until Mr. Putin invaded Ukraine. And secondly, they wanted the denuclearization of the continent, because nuclear power was bound up very tightly with nuclear weapons and American deployments in particular. So in energy, that happened. So suddenly you had people saying, oh, well, actually, maybe energy is not evil. We do actually need it. Maybe we can include BP and the like in our ESG indices. And you have the same thing for defense. A lot of people wouldn't touch defense companies. They said, can't touch these for ESG reasons. But, oh, wait, selling weapons to people who are defending themselves actually maybe is quite moral. So maybe we should include things like BAE. So I think that a lot of naive thinking that's been easy to propagate off the back of very stable and high returning period for asset markets and the world more broadly is being challenged. Do I think that ESG is just going to fall by the wayside? Absolutely not. And it does cover important things. It's just that I think the tenor of the debate has changed actually in a helpful way. So hopefully that gives you a sense of where I come down. Our firm view, by the way, is that, as in a firm with a capital F rather than assertive view, is that engagement is king. We're unconstrained, we're unbenchmarked, we can own anything. We don't go around saying, right, we're going to cancel that kind of investment because we don't like it, because you'll just leave it for someone else who doesn't care. So we'd much rather own something that's useful for the portfolio, and also go and talk to BP after the latest strategic plan to understand exactly how it stacks up next to their carbon commitments.
Thank you.
Great
I don't
answer,
seem to be
Alex.
able to
Great
take
answer.
my hand down.
It's
Thank you,
down.
Con.
It's down, Con. Thank you very
Okay.
much. Alex, that's a great response as well. Thank you very much. Any other questions? We're nearly at time now to wrap up. Any other questions for Alex, which I thought has been absolutely fantastic. A superior presentation. I've already had a few texts from people saying what a fantastic presentation it was. So Alex, that's really, really big thumbs up to you and to your team there at Ruffer.
Well, thank you, Stephen. I'm most grateful for everyone's time and questions and engagement. I really appreciate it.
A quick question. I know it's 80 slides. Are you able to, or are you happy to distribute those slides to a few of the people if any of them
Yes.
want them? Or
Yeah,
that's
absolutely.
good. Yeah, that's good.
We'll send them to you, Stephen, then you can
Yeah,
distribute
send them to
as you
me,
see
and then
fit.
if anybody wants them, then please come back to me. But Alex, I've got to say that was fantastic presentation, very high quality, very professional, and yeah, wow, superb. That's all I can say. Fantastic.
Thanks so
So
much,
thanks
Steve.
for your time. Really appreciate that. Next week, we have Keith Richards, the CEO of the PFS, Personal Finance Society,
I was hoping you were going to say
or of the Rolling Stones.
of the Rolling Stones. I thought, God, I was lucky I got in before him because
He's going to give us a private.
He's
going to give us a private sort of solo sort of session. But no, sadly, the other Keith Richards of the PFS, and again on Pinch and Playpen. This is the. I mean, obviously, Ruffer get introduced business as well, but it's the wonderful world of advice and what's occurring and what what is the direction of travel on advice. So the CEO of the PFS is talking next Tuesday. Hope you can join us. We hope you love Playpen, and we as usual pray for peace in the East. So thanks everyone. Enjoy the rest of your day.
Thanks, Steve.
Amen. Thanks Alex.
Thanks
Thanks
so much.
Toby. Thanks
Cheers.
James.
Thank you.
All right, take care.
Bye.